来连线 Monica。在连线之前，简单的了解一下东方汇理。东方汇理是欧洲最大的资产管理机构，最新管理规模1.9万亿欧元，折合14.8万亿元人民币。东方汇理是一家以研究驱动的资产管理机构。东方汇理也非常重视中国，它将中国作为第2本土市场，在中国拥有汇华理财、农银汇理基金等合资公司。东方汇理同时表示，还会继续探索在中国的机会。Monica 自2001年起一直领导东方汇理策略研究工作，她于2017年被任命为集团研究副主管和全球投资委员会成员，负责制定东方汇理在金融市场上的投资策略。2022年10月，他被任命为研究院的主管。现在 Monica 已经在线上了，我们来连线她。Hi, Monica.
Hi.
Great. Yeah. So first, would you please say hi to our audience? Okay. We have Hao with us. First, please allow me to introduce him a bit. Hao is a partner and chief economist at the Grow Group, and the latter emerging global investment firm in China. He has previously served as the head of research at Bocom International, as chief global strategist at CICC, and he has worked in the London, New York, and Sydney office of international financial institutions like Citigroup or Morgan Stanley. Notably, he has garnered recognition from both the general public and professional investors. And without any exaggeration, he's quite an influencer in the finance world in China. So I'm really proud both of you with us. Without further ado, let's dive right into the discussion. So Monica, I want to start with you. Last July, we did an interview with Vincent, and he joined from the Paris office. Vincent told us that it was a super hot day in Paris that day, and the temperature reached 42 Celsius. That is 108 Fahrenheit. At the time, the energy crisis was still going on. So lucky us, part of that was behind us. And this brought me to your 2023 Global Market Outlook, which is titled Some Light for Investors After the Storm. Now we are approaching the midpoint of this year. So how have things unfolded compared to your prediction?
Well, let me start saying that I'm connected from Milan. It's extremely chilly. We have 19 degrees, which is really unusual, being mid-June. So, starting from the outlook, we thought at that time that there were 3 main themes that we are going to reiterate in the remainder of the year with different emphasis. Some came out as a confirmation, some others as surprises. So we had the U.S. Fed pivot, which is still taking central stage in the financial markets. We do expect the Fed to pause, and we do not believe that they will cut rates this year. This is a story that will be displayed later in 2024. The second is the Chinese growth path. It was important back at the time we set the outlook for this year, but it's still important now that April and May data are a little bit confusing, but notably China is a very important driver of economic growth, and it will remain on a moderate economic path. The surprise, as you were mentioning, is the energy crisis, because cool and stabilizer at lower level, but at the same time, in particular in Europe, because this was really the hot theme for Europe, we have been able to diversify suppliers and really start moving probably faster towards an energy independence that at this stage is really key crucial for some in particular for some countries, notably Italy, but also for Germany in the euro area. So when it goes to the economic projections, we've been revising them at global level. We had 2.2 that has been lifted to 2.9 for this year, 2.7, 2.5 next year when it goes to global growth. And this is really coming from different some divergences within the big regions, US, China, and while when it goes to inflation, we were thinking that some kind of slow moderation would have been in place, and actually this is what is happening. Inflation is stubborn and sticky, but is on a lower trend. Then when it goes to regions, there is a different degree of patience. I would say if you look at the United States or if you look into Europe, but we do not expect inflation to move down to target to the 2% target under our forecasting horizon. Having in mind that if these regions commit seriously to the energy transition, some investments and some commodities demand will maintain a higher level of inflation when compared to the central bank's targets. The market that have been performing extremely well, although there is some concentration on some equity indexes, notably the S&P 500 with the tech sector, but volatility has remained overall contained, not despite what all was happening on the geopolitical front, on the uncertainty, on the macro development and on the markets.
Yeah, I think probably Europe behave probably as like falsify many people's assumptions starting in 2022, right? So it is not as bad as expected, right?
Definitely not. And the game changer had been really the energy crisis. So we thought that with much higher gas and oil prices, this would have been quite detrimental for the countries within the region. And thanks to the stabilization to lower level of energy prices, this has not been materializing. Moving forward, having in mind that energy prices will remain contained, thanks to some still alive fiscal support, expect some kind of resilience to be maintained into the region.
Okay, so next I want to get to U.S. So how many economists predicted a potential recession in the U.S. even in this year? Also, they have different interpretations of a recession. So could you please share with us your thoughts on the likelihood of a U.S. recession in this year and its potential impact on China market or China's economy?
Yeah, well, I think if a U.S. recession really did eventuate towards the fourth quarter this year, it would be the most broadcasted recession ever. So I think if you look at the consensus in the street, and basically, just about every economist I know is forecasting a recession. And also, if you look at for example, the New York Fed's probability of a U.S. recession in the next 12 months, I think it's now higher than 70%. Whenever the recession probability is this high, it's almost no escape that run into a recession later this year. But having said all that, economic data from the U.S. is very strong, right? So it's just exceptional. The job market is showing tremendous tightness in the labor supply, and also the labor compensation. For some reason, despite a very tight market, labor compensation is not growing as fast as we thought it should be, right? So I think that's giving the Fed some leeway. And also, if you look at the inflation level, it's coming down quite fast. And I think going into May, we are likely to see inflation level coming down even faster, because the base effect from last year's Ukraine invasion has disappeared. So then that way, from May onwards, you're probably going to see a faster deceleration of the inflationary trend that was shown this year. So all in all, despite, a very well broadcasted, recession, despite very high probability from the Fed, showing, the likelihood of a U.S. recession is, quite high. And also despite a yield curve that has been inverted for a long time now, right? But the odds of a U.S. recession is actually residing, right? So, but we're still thinking that it's possible, because the job market tend to be a lagging indicator of the economy, even though the U.S. stock market is very strong now, but stock market tend to sort of run ahead of itself, especially nowadays, the liquidity in the US system is still abundant, et cetera, et cetera. So we would say that the odds are lower now, but then, we're still, thinking that we might be entering a shallow recession that, may not feel as bad as many people were before this.
So you mentioned a recession did happen in Q4 this year, it will be the most forecasted recession.
That's right.
And let's get to the mechanism of market reaction. If everybody forecasts there is a recession, does that mitigate the risk? Or they talk the recession into truth. So what do you think?
Yeah, the self-fulfilling hypothesis, right? It is possible. I mean, if you think of it this way, right? So last year, US market had a really bad year last year. Both bonds and stocks did really poorly last year. And, because the stock market tend to lead the real economy by, 12, 18 months, you could say that, well, maybe we had the adjustment already, right? Last year, because the stock market is a leading indicator. And also, if you look at the excess saving in the U.S. banking system, we're still talking about $600 billion, well over $600 billion US dollars worth of excess saving the U.S. consumer into the fourth quarter of this year. Right. So then going into next year, because of the U.S. election, the existing president tend to go all out on all sorts of stimulus and spending. Right. So because of that, it makes it even less likely to have a U.S. recession, right? So, all in all, it is a tough call for me right now. So, but, because I'm a macro strategist, so for me, it's more about how the market would reflect, what's going to happen down the road. And, to me, the market action is telling me that, we shouldn't be too bearish. We shouldn't be too negative about, what's coming, in the fourth quarter.
Okay, Monica, what do you think? Do you want to put a number on the likelihood of U.S. recession in this year?
Well, we are almost certain that the recession will materialize. The real question is when, how deep, and for how long. So this is really what eventually is going to matter. So when we think the United States will enter into recession later in the third quarter, and this is going to prosecute into the first and second quarter, likely, of 2024. The recession will come from tightening in financing and financial conditions, because as Hong was mentioning, the labor market remains overall resilient, and the consumers still show decent level of consumption, although they've been eroding progressively their savings. And, getting 20% interest rates on your credit cards eventually is going to have an effect. When it goes to the market reaction, probably the market won't be disappointed by the recession, but probably from the Fed reaction, because most of market participants, because of the recession, expect the Fed to start cutting rate and again being helpful for the market. We tend to see, I'm inclined to see really the Fed as independent, with not a huge inflation. So they might temper their action, not to preserve financial stability, but remaining focused on the inflation target. So probably the disappointment might come from the Fed monetary policy and reaction function, the more so on a recession that we expect to be shallow.
Okay, so we talked about the possibility of a recession in the United States that is highly correlated with another factor, inflation. So if inflation in the United States persists at a higher level for longer, do you anticipate other vulnerabilities like that happened in the banking sector in the United States? Monica, what do you think?
Well, just let me qualify a little bit the target we have in mind as projection for inflation. We have a 4.2 this year and 2.6 next year. This is, again, it's data dependent, so you really need to take them with that is needed. So obviously, inflation is going to erode disposable income, and this is not good news for the U.S. consumers. But we think that inflation is something that will be entrenched higher. But you do not have to look at inflation as a monolith, but really look at the component of inflation, PPI, CPI, PCE, unit labor cost. If you drill it down at least at these four pillars, you might be able to invest and to proof your portfolios for inflation. So this is actually what we do. It is true that some sectors, the most interest rate sensitive, real estate, information technology, might suffer because of an higher interest rate. But having said that, there is plenty of opportunity in the real asset space, an alternative be displayed and used by investors to preserve the value in their investments and portfolios.
So Monica just talked about we can still find some sectors that can protect us against a sustained higher inflation in the United States. So I was asking, is there any sector in the United States that you find particularly worrying? So like, do you find the commercial real estate particularly problematic?
Yes. I mean, after all, it's a very interest rate sensitive sector. And also, because of 10 consecutively hike by the Fed, now the US Fed fund rate is at 5% and above. So even if the Fed would be able to pause for 1 or 2 months, 1 or 2 times of interest rate hike, the problem is that, now the interest rate is substantially higher than before. The vacancy rate in many of the U.S. commercial buildings, we're seeing very high vacancy rate in many of the major cities, such as San Francisco and New York. Yesterday, I saw a statistics, I think from one of the research, CBRE, one of the research organizations, showing vacancy rate of commercial buildings in San Francisco is even higher than, some of the cities, tier 1 cities in China, which is a huge surprise to me. And I think, besides higher rate and all that, the pandemic actually make people work differently, right? So people now move away from big cities, and also, places like New York and San Francisco, they are notorious for higher state tax, right? So if people move to Texas or Florida, for example, they can get a substantial tax break. So one should be worried about, commercial real estate. But having said that, I agree with Monica. Monica just said that, some base material, alternative assets, they have good investment value, especially now that, inflation has peaked, even though it's going to be sticky, but it has peaked, and inflation level, inflation growth rate is coming down. The level is still very high, but inflation growth rate is coming down. And therefore, the Fed may be able to have some leeway, right, to maneuver its interest rate policy. And when that happens, we should see like growth asset technology companies, for example, they should outperform, and they're already outperforming, right? So, for example, Apple, as a one of the largest firm in the world, is up 41% this year. It's making new high last night, right? So it's coming out with all this, highly anticipated gadgets for consumers. So I would say that, because of that, because of the interest rate level might have reached a very high plateau, able to come down here, because technology is still changing people's life and it's making breakthroughs such as AI technology. And also, if you look at the earnings season, more than 70% of the US listed firms actually beat and raise expectation, right? So it's substantial, right? And I think that in part explains why the US market is so strong. So yeah, so I think me and Monica are on the same page in the sense that we have alternative.
And I was wondering what could be the signals that would eventually motivate regulators to implement the stimulation.
Yeah, I think in the second quarter, in the up and coming second quarter results, we're still going to see relatively high GDP growth rate. The second quarter GDP growth rate is probably going to be higher than the first quarter because of low base effect. So if you roll out a huge stimulus package, you may not be able to easily justify such a huge package. But once we get into the later this year, once the stimulative effect from the earlier policy sort of wear off, then you will see some slowdown especially in the consumer sector, right? So because the housing sector is not doing well, consumer very busy saving money rather than spending it, etc., etc. So I would say that if consumption, for example, total retail sales grows down, and then at the same time, if home sales in many of the cities continue to trend down, and at the same time, real estate investments, they're still where it is right now, it's like -5%, then it calls for stimulus help from the government. I think for now, more and more, I can see that more and more economists in the market sort of coming around. But I would say that if this time, we continue to stimulate the real estate sector, the property sector, it may not help as much as before because, the Chinese households has bought like so much properties you wouldn't believe, right? So 70% of the Chinese households as allocation is in property, right? So if you continue to pump this sector, it could actually skew, the entire economy further away, from what it should be, the right path. I would say that if we do come up with some stimulus package, it will be so much better off in the form of, help to the consumer, for example, like what the overseas countries experience, right? So the government actually hand out cash or coupon households, to help them to spend. And that way, using consumption and the household department as the driver for economic recovery rather than, the old recipe, you stimulate investment, stimulate.
China has entered a transformation of its economic growth model towards a more balanced, fair, and equal growth that, in our opinion, will be more sustainable over time. So when you enter such a transformation, it might happen that you have a short-term fluctuations, and this is what we are seeing. So in terms of numbers, we have a 5.7 economic growth projection for this year, that when compared to the official target set by the government, 5% is in the upper bound. And this is explaining why we are on the region. Then there are obviously some critical aspects, namely youth unemployment, the real estate, and consumer confidence. So when it goes to the policy support, it would be really an exercise to balance between the 5% target, and we really think they will overshoot this target, and maintaining and preserve at least these three layers within the economic trend. Having said that, there is an appeal when it goes to valuation, in particular onshore, and in relative terms, there is a growth premium that is there, and that will offer appeal to the investors. Having in mind that you cannot get rid of tactical fluctuation when you enter such a big transformation in the economy.
Okay, that's well, if we compare the sentiment of global investors with that in domestic investors, how do you believe global investors are more pessimistic or optimistic at this point toward China?
I can't speak for the global investors because I'm based in China. But from my interaction with them, and also hearing from Monica just now, I actually think that, global investors are probably more optimistic than many of the domestic investors that I've met. I think many of them are very bogged down by the recent weakness in economic data. And as you can see, like if you look at the Chinese newspaper, it's infested with negative headlines, right? So, but then when I talk to global investors, I tend to get a sense of optimism. I think it's because the global investors, they tend to have a longer term view, right? So if you think that China will continue to grow, to be one of the important growth engines of the world, then one should hide out the short term difficulties so that you can get to the long term. So I think that's one of the reasons why we have sort of two different sentiments. For the domestic guys, they seem to be unconsolable. But then, with the global guys, they tend to be more upbeat, more optimistic.
And also, I think probably a comparative perspective also helps, Monica, right? Because there is no perfect place in the world at this point, right?
Yes, true. But maybe what we can say is that there is this domestic bias pessimism that is featuring everyone. But from a global perspective, really, what you have to look at is the long-term horizon, the long-term structural theme that is there, the potential for diversification, and the potential for higher returns. And I think that under this perspective, really, this is making the case study for China, which doesn't mean that you don't have to fine tune and articulate your risk exposure to the region, but you can always play and position on the currency, on the fixed income, on the equity, and fine tuning the size of your exposure. And this is basically what we are doing.
Okay, so that's very helpful. Next, I want to get to some long-term trends. And Monica, I heard from another news media, probably Bloomberg, that legendary investor Stanley Druckenmiller reviewed that AI-related stock now dominated his long portfolio. So do you think another round of technological revolution, and how should investors prepare for it?
I don't think that we are in a technological revolution, because it's under our eyes already. Then you need to distinguish artificial intelligence, what we mean and what kind of models we are using. We are using artificial what we mean and what kind of models we are using. We are using artificial intelligence in our econometrics efforts on the machine learning to crunch big data. Think about COVID, for example. At that time, GDP projection were unreliable, not informative. So we really had to look at big data on micro and high frequency, and machine learning was extremely helpful on that front. We are using it for textual, for translation, and is super powerful. Having said that, when it goes to forecast it's less evident the power of this artificial. Really need to look at it carefully, having strong fundamentals on your background in order also to distill all the amount of information that is coming out from this super powerful engine. But for some, type of jobs that are repeating themselves, this might be definitely quite useful. Whether we will have productivity gains, inflation, and we can solve the demographic issue, it's in progress. This I cannot give you a definitive answer, but this is what we're currently focusing on the moment.
Okay, so it's always helpful to be disciplined and to get down to the fundamentals, right? Honghao, let's get to China. So in a market largely driven by retail investors, we have witnessed countless long-term trends be treated as short-term fashions. So given that, how should investors positioning themselves for these long-term trends?
There are many long-term trends, though. The demographic obviously is slowing, right? So, there are only 683 million, 6.83 million couple got married last year. So I think it's gonna heralding a new level of low birth rate, some year down the track. All right. So, it's concerning, but then at the same time, we're seeing AI technology breakthrough, as Monica said, it's actually changing the way we are investing our money, right? So it's changing how we analyze market data and how we allocate our assets across the globe. So, I would say that, there are many opportunities, but then at the same time, there are like longer term threats as well. So I think for the Chinese market, right? So if you look at the transaction volume in the Chinese market, it's actually the most active market in the world. So we trade about, 1 to 1.5 trillion yuan worth of stocks every day, right? So it's just phenomenal. In such a market where, people generate value by actively trade the market rather than by investing for the longer term and grow with the company. It's two different sort of philosophy to invest, right? So in the more developed market, for example, in the US, we have Warren Buffett, he is able to hold on to his position for like decades. And, here in China, we may have trouble holding on to our position for like 10 days, right? 10 hours. So it is entirely different. And I think, it takes time, because the Chinese market is still very young. It's like 30 years old, right? So many of the retail investors, they are treating the stock market as a casino, right? So they sort of gamble, speculate, trying to outwit their trading opponents so that they can, make some money out of it. But it is just really a wrong way of doing it, right? Because, by trading to create value, basically it will wear you down over the long run, because you can't promise, you can't make sure that you are always smart. This, always be, one of these days you got beaten up. So, it is hard. It takes a long time to educate. And I think already after 30 years, in the making, we already substantially, than the early days, say in the early 90s, right? So stocks can go up like 50% in a day. And I think that is one of the reasons, speculative theta was so prevalent back then, that, we come up with a limit stop, on a daily limit stop on trading, right? So now that we can only go up 10% a day, et cetera, et cetera. So I think things are changing. People are getting educated over time, but it takes time. So I think to truly grasp the longer term secular trend, people need to change their mindset. We need to change how we educate our people. We need to change how we punish, wrongdoers in the market. Irregular trading behaviors in the market. Deceit, all sorts of, stock trading criminals and all that. So to protect investors, for the longer term, investment horizon. So then that way, I believe that over time, things are bound to change. And already, like say, for example, the Chinese funds management industry has grown tremendously in the past couple of years. All right, so now the size of the mutual fund and also the privately managed fund has reached well over tens of trillions of yuan already. All right, so it's a major force in the market. And as the market gets more and more institutionalized, I think it's bound to get more regulated, and therefore, people will be positioning for the longer term investment opportunities.
Well, that's a very helpful, thorough analysis. So it calls for action from all sides to build a healthy capital market and for the investor to be better protected. But well, let's first answer the simple question. So for normal investors, individual investors, to avoid overpaying for the hypes, should we just avoid all the things in the market or just stay put?
I would say that AI is a genuine opportunity for the longer term, right? So it really changed the way we work. It changed the way how we make a living. So, it's a genuine change in the society, and we can actually sense it happen, right? So, as you use ChatGPT, you can feel how powerful it is. So, I think, people, when you say hypes, all sort of bubbles, for example, back in 2000s, the internet bubble, right? So it starts with hype, right? So all this internet, all the computers connect together, and then you get all sorts of information. And now we're in a second revolution of the computer industry. So I think people should participate, but then at the same time, we want to make sure that we don't sort of overpay for the secular opportunities. And therefore, I think for ordinary investors, they can consult with professionals such as Monica, to get ideas about, how best to go forward.
Okay, that's very helpful. And speaking of ChatGPT and the power of generative AI, I have a confession to make, and I use ChatGPT to help me generate part of the question list to you guys. So that is my confession. It's definitely, and I'm seeing it replacing part of my job in the near future. Probably it is happening. So Monica, do you think AI will replace part of a strategist job in the next decade, and which part will be replaced?
I think it will replace most of the data crunching and all the recurrent job that we have to do. It can definitely help us distilling information out of big data, but also it can also help us in wrapping long readings in major points. And I confess that I did it. Then because I'm a little bit seasoned, I went back to the full report just to make sure that ChatGPT was doing the right job. So to this extent, definitely, it will be extremely helpful. But as I was saying, it is really important that eventually you supervise and you control the output of ChatGPT or artificial intelligence in order really to make sure that you are not relying on fake information. The quality of data is really important. So it is something that we sometimes underestimate, but data analysis and data scientists are tremendously. You can feed the computer with very long time series, but if data quality is not secured, you might terrible and wrong conclusions. So it helps, it will help, but it needs to be supervised.
Okay, that's very helpful. And Honghao, I believe there is probably one distinct feature of your research report that can hardly be replaced by AI. As I think people investing in China are pretty familiar that you always have some philosophic reflection on humanity contained in your report, which is very unique. Can you share with us, do you think a philosophic angle can provide insights on how the market is moving in the short term or probably even in the long term?
Yeah, thanks for such a generous comment. I think, because I worked in sales side for a long time. So, and also the sales side research in China is so highly competitive, right? So you have to differentiate yourself. And I think, because I've worked in a Western market before, and as well as the Chinese market and Hong Kong market, I try to combine, different perspectives together. Right? So I think a philosophical way, or a philosophical approach to to analyze investment situation and problems, it gives you a better perspective, right? So it moves beyond just data analysis, charting, and all that, because data, we all have access to data, and I'm pretty sure that some of the quantitative analysts, they probably are more adept, to do data analysis than me. I'm an old timer. But I think, bringing your game to a new higher level actually makes you see the entire picture more clearly. And also I make sure that I talk to, top rated investment firms as much as possible, so that to get their perspectives as well. So now that I am, managing some of the institution money here in Hong Kong, I found it particularly useful to combine different perspective and also a buy side and a sell side approach, to analyze, the investment situation. So I think in 2022, it was a unique year in the sense that, both bonds and stocks are plunging together, right? So it hasn't happened for the past 40 years. And so if you use the old model, if you use the old mentality to analyze the situation, one of the obvious conclusion you could draw is that you would put all your money into the bonds because it's safer, right? Historically speaking. But, that's precisely the wrong place to put it, because last year, US bonds did even worse than the US stocks, right? So I think, for a unique situation is this, where you can't rely on past history as guidance for forward results, then you have to rise above the existing game, and bring in different perspective to better analyze the situation.
That's very helpful. And you know what? It makes me feel much better, because I studied philosophy at graduate school. I remember the first day, so I entered the graduate school. A PhD student told me philosophy can only be useful when you are not doing philosophy. It seems to be proved by you. So yeah, so we've covered lots of ground, and the next